All right, today we're going to be talking about direct recognition versus non-direct recognition. I feel like this is like the age-old debate in the infinite banking community, and we've had some videos that we've touched on it, but I don't think we've ever had any video that we've made that goes right on the direct versus non-direct. And to break this down, we have one of our wealth coaches, Austin Williams.
Hey,
how's it going, man?
It's going very well, sir. How are you doing?
Doing awesome, and I'm excited to talk about this. I know the conclusion, which I agree with the conclusion, but I know that you're going to bring up some points and you have some slideshows and some examples I think is really going to flesh this debate of direct versus non-direct recognition when it comes to life insurance.
Yeah, absolutely. I'm excited to do this. And this is going to be a quick video because I don't think we need to belabor the point here. Simply put, yes, there's two different kinds of ways that dividends can get recognized, direct and non-direct. As I made this whole slideshow, I heard in my head the collective sigh of thousands of life insurance agents who've had to explain this to people who have varying levels of interest or knowledge in it. And ultimately, we'll get to the point we get to at the end. I think it's something that's good to know. I don't think it's maybe the most important thing about a policy, but I certainly think it is good to know. And that brings me to the first slide, which is that if this is your first video that you are seeing on this channel, stop. Do not go any further. Maybe this should have made a stop sign. Just stop, turn around. Do not go any further. This is way too into the weeds. First, learn about kind of the purpose of life insurance. Like, why do you get life insurance? Then maybe you learn about, okay, what is like the strategy to use life insurance? What is infinite banking like? What does overfunding this look like? And then start there. And then once you've kind of gotten like the 30,000 foot understanding of it and you're comfortable going into the weeds, then you can come back and watch this video because ultimately this is a very, very nuts and bolts kind of look at something under the hood of what's going on in the policy. As I said, I kind of heard the collective sigh of thousands of agents because I feel like every time I explain, if somebody asks me the question, what is direct? And or is this direct recognition or is this not direct recognition? I've unfailingly managed to disappoint them. Like no matter what it is, like no matter how I explain it to them, I've tried so many different ways. It's like there's not like this secret sauce of like this magic company that everybody is happy with. So
I find that it's literally just a sales tactic for people to say they can kind of say whatever they want to say. And the whole pitch of it is, hey, this company's better than this company because of how they recognize dividends. And there's maybe elements of truth to any statement that's being made. But I think when you zoom out, you realize like, oh, we might be taking this out of context, or maybe we're overhyping something that doesn't matter as much. But when I first got into the business, I was pretty much told from multiple people that if you are going to do infinite banking style life insurance policies, it has to be with a non-direct recognition company because, and we're going to define what that means in a second. But if it's with direct recognition company, it falls apart or doesn't work as well. There's other people saying that. And so whether you're a client of ours or whether you work with someone else or whether you're doing research, welcome. And I hope that this video makes it more clear. So without further ado, do you want to define what?
Let's do it. Yeah. All right. What is recognition? What are we even talking about? So basically put, recognition deals with how a carrier awards dividends to dollars inside the cash value of a policy. As you may recall, all dollars that you put into a policy, ultimately, foundationally, they buy death benefit. That's what happens. But a portion of that death benefit is available for you to use before you die. That's the cash value. So ultimately, recognition deals with, okay, so how are you going to get dividends awarded to the cash value of the policy? The way that we build policies at Better Wealth is that we obviously are using the dividends to increase the cash value of the policy. So, we want those dividends we want to put them to work and we want them to do as much work as possible. So we want to choose carriers that are going to allow those dividends to be used in the client's best interest, right? Historically, if you know much about infinite banking, usually people have preferred non-direct recognition carriers for borrowing against the cash value of your policy. Maybe you're new to this and you say, no, I actually don't even know that. Why is that? Well, here's why. So direct recognition carriers, this when the carrier recognizes the difference between loaned dollars and non-loaned dollars and awards different sets of dividends to each. So think of like a bucket over here, and this is your non-loan dollars, and this is your bucket of loan dollars. Let's just take a number. Let's say you have $100,000 in your cash value. Let's say out of that 100,000, let's say 25,000 is loaned. All right. And that's over here. And you have 75,000 that is not loaned over here. So a direct recognition carrier is going to give you a different set of dividends for the 25,000 and the 75,000. All right. Now, non-direct recognition is that there's no difference. Is this no matter if you've loaned against it or you've not loaned against it, the amount of dividends you're going to get for each set of dollars is the exact same. So pretty simple right there, right? So two different ways of doing the same thing. Now, historically, people have said like, oh, like you said, like there's no way that maybe you could do a direct recognition carrier and do investment banking because, you don't want your borrowing to affect anything inside your policy. And like, while that's one way to look at it, that's certainly not the full picture. And we're going to get into that, why that is a little bit more now, because ultimately in these mutual insurance carriers, anyone's borrowing activity could affect the dollars inside your policy, and that will bear fruit in both of the different ways that the carriers kind of go about awarding dividends.
Hey guys, I just wanted to interrupt real quick. If you're watching this and have an index universal life policy, a whole life policy, have any type of insurance policy in general, and you're like, I want to know if I'm on the right track, I want to know if this is set up properly, we at Better Wealth want to help you. We want to give you a free policy analysis and show you, are you on the right track? Is there some things that you potentially could be doing better? And so we have a link down below that you will have access to. We would encourage you, if you have a policy and you want to see if you're on the right track, check that out. And if you're someone that's watching this and you're like, I want to talk to someone maybe setting up a policy for myself, or I have questions, we would love to serve you. You can also see a link to have a call with someone on our team. Back to the episode. Austin, just to summarize, you tell me if I'm on the right track. When it comes to non-direct recognition, means companies do not directly recognize the loan, and they're going to pay you the same dividend regardless of your activity. Direct recognition just means I'm going to recognize that you're taking a loan, and I'm going to have the ability to adjust what you're getting paid for better or for worse because of that activity.
Yep.
Got it.
Yeah. A couple examples of direct recognition carriers. Both of these really, really highly rated, super high Comdex scores. Like, there's no sort of like there's nothing about them because they're direct that's like, ooh, they're not quite as good. Like, they are incredibly highly rated. We definitely love using direct recognition carriers for our business. And right now, just to choose one, in 2025, so the dividend interest rate for Penn Mutual, 6%. The policy loan interest rate is, 5.3%. The way that this Penn Mutual is going to recognize a policy loan, if you were to take it out with them, let's say in the same example, you had $100,000 with Penn Mutual, you wanted to borrow against $25,000. What they're going to do is for the $75,000, they're going to give you that 6% dividend rate because it's not loaned. And then let's say you have that $25,000 loan. So at Penn Mutual, you're going to get the policy loan interest rate, but for the first 10 years of the policy, there's a 65 basis point spread. So they're going to take whatever the policy loan interest rate is minus 65 basis points or 0.65%. And then that is going to be the dividend rate that you get for those loan dollars for the time in which they're collateralized. As soon as you pay off or satisfy the loan, you start getting the dividend interest rate again. With Guardian, they have a slightly different policy. They have a static loan for the first 10 years at 5% right now, and their spread is 1%. So whatever the policy loan is, you're going to get 4% on dividends for those dollars that have been borrowed against. So once again, two slightly different ways to do the same thing, both direct recognition. Now, benefits of going this route is that, let's say we're in an environment where the policy loan interest rate is not underneath the dividend rate. Let's say it's inverted. So let's just say for a second that the prime rate goes up, the interest rate environment goes up, and now the policy loan interest rate, so like for instance, Penn Mutual, it's variable, so it could go up in a given year. Let's say it goes up and it becomes 9%. At Penn Mutual, now let's say your policy, and you think, oh, that's horrible. I'm only getting 6% dividend, but I'm getting a 9% policy loan. But the dividend you're getting on those loan dollars is based off of the policy loan interest rate. So for that $25,000, it's actually based off the 9%, right? So the 9%, and then obviously that 65 basis point spread for the first 10 years, but you get a higher interest rate because you're using those dollars based off what the current policy loan interest rate is. And basically, the policy loan interest rate and the dividends, they track closely together. So they're not often too far apart, but they generally track closely together. So so that's basically how getting a policy loan works at Penn Mutual. Guardian is similar, slightly different way that they do it, but once again, direct recognition. So the next one, so these are non-direct recognition carriers. Mass Mutual, Lafayette Life, both very highly rated. We only work with extremely highly rated carriers, and these are both carriers that we such as this, that we love sending people to non-direct recognition carriers if it aligns with their goals. Now, with non-direct recognition carriers, it's going to work a little bit differently, and that's going to bring me to my next slide here. So this one is this is a marketing material from Lafayette Life. Now, Lafayette Life, they don't have any difference in dividends that get awarded between non-loan dollars and loan dollars. However, depending on the month of the year that you get your policy loan out in, it will affect what that loan interest rate is. And so as you see, like for 2024 to 2025, there was a lot of 5% loans, which is nice and low. But then it jumped all the way to 7%, all the way, through January of 2025 to 2026. So, and that's just something you got to accept with going in with a non-direct recognition carrier, is that there's a lot of variability throughout the year. And if there's ever an interest environment that's inverted where the policy loan interest rate is above the dividend rate, because like right now at Lafayette Life, their dividend rate for 2025 was 5.75%. And remember Penn Mutual's was 6%. Even if you're paying a 7% loan on that 5.75%, because they're not direct recognition, they're not going to actually recognize it off of the policy loan. It's just going to be off of that 5.75%. So there's not going to be like a positive arbitrage thing that you can gain from that. So that's just something that you got to accept, is that, you're not going to have necessarily get a competitive dividend depending on like what the market is like. And you're just going to have to accept long-term that it's going to work out in the end.
And I know that you have a cool analogy, but even before we go into that, if you're working with a mutual insurance company who you're making a bet that you're like, hey, I want to be partners with you for the next 20, 30, 40 years, 50 years. And there's all kinds of things. The same thing when it comes to dividend rates. And when it comes to this, they can all be somewhat misleading because there's a lot of different levers. And what you will ultimately have to do is, am I working with a company that has a track record and has a future desire to put me, the policyholder, the mutual part owner of this company first? Because what I even see here is you could be talking about direct recognition and there's that little bit of spread, but you could easily look at today in history and say that you're actually still better off with that than maybe going with insurance company that has a higher loan. But then there's worlds where that loan will come down, where there's a world where people will raise their dividend rates, but their expense ratios might be different. And at the end of the day, you can easily point to one mechanism and say, this is better than that. You're taking the whole package. It's like, you might like an ingredient of the soup, but you're taking the whole result of the soup, not just one ingredient. And that's where, when we have really boiled it down, it's like, yeah, these things matter. It's awesome, but it's at the end of the day, what is the end result? What is the cash that we have available? What are the track record long term? What is the internal rate of return long term when we factor in all these things? And all those things matter. I know you have a really good example that I think drives us home.
Yeah, and we'll get to that in a little bit. Yeah, but like, what's ultimately what I bring people back to is like, what is the purpose of life insurance? Is providing peace of mind for the people who depend on you for, a living, right? It's like, how well does it do that? Like, what is the death benefit? Like, there's so many other constituent components. And last thing I'll say about non-direct recognition is that, like, let's say you have a bunch of people at the carrier at a non-direct that are borrowing at below market rates, which is the most ideal environment, right? For you, supposedly for infinite banking practitioners. If everyone is borrowing at below market rates, that's going to affect their profit, which will in turn affect your dividend. You are enjoying a low market rate, but you're also going to pay for it likely with a lower dividend. Something I didn't include here is just like the difference in yearly dividends for like the last like 10-ish or so years with Lafayette Life versus Penn was like a whole percentage point, right? It was pretty much like Penn, like Lafayette's been like 5.2 and Penn has been like 6 or slightly above for like the last 10 years. And like, that's just, once again, if you are paying a slightly higher interest rate than the environment, it's also increasing their profits, like in Penn Mutual. Therefore, your dividend is also going to be higher in the policy. And so, neither scenario is the right scenario, but you just got to be aware of both as you go into it. Right. So here's the upshot, and I'm going to share the analogy that I shared with Caleb, is that in the end, our opinion, it's likely a wash. Regardless of which one you go with, as you said, it's the soup, it's the totality of the policy you want to look at. The analogy I had is, let's say you were in a car and you wanted to drive from New York City all the way to Los Angeles. And does the tire pressure in your wheels, does that matter for the trip in terms of achieving the best MPG? Absolutely. That matters a ton, especially over like 2,000 miles. But does it also matter whether you're like in a car, like a Prius or like a Hummer? Does that also matter for your MPG? Does it matter if you have the windows down, windows up? Does it matter how many passengers you have? Does it matter how long it's been since you serviced the engine? Like, there's so many other things that also matter that you have to look at like the whole package and say like, is this entire thing good? And if maybe one part, maybe if it's not direct recognition or direct recognition, it's probably not the most important part of the entire whole. So that's where it gets there. So If you're still here watching the video, one of two scenarios apply to you. Either you are comfortable knowing the spread between your dividends and getting a competitive dividend rate compared to the policy loan interest rate, so you go with direct recognition, or you are comfortable with the variability of taking a policy loan in a month where the policy loan rate could be higher or lower than the dividends you're receiving, and you're just going to trust that it's going to work itself out in the end. And then you go with non-direct recognition. Either way is fine.
In summary, when I talk about policy loans, it's very much contingent on what you're using it for, because it's the idea, whether it's direct recognition or non-direct recognition, your policy is still going to be growing in value. Either one of those still going to be growing in value. Yeah. It might depend on how it's credited. So that's one factor. If you're going to take a policy loan out, why are you taking that out? And what are you using it for? And is that activity a net positive or a net negative to your life, to your family, to your portfolio? It doesn't matter direct or non-direct when it comes to that. It really matters on what's the cost of controlling that money, and then, factoring that in. I really appreciate you breaking this down. And I'll also say, if you're watching this and would like us to review your policy, your situation, we do that. If you want to learn more about life insurance and see if this would be a good strategy for you, we can help you. And we can also just set up a time to get clarity on your situation. So there'll be links down below on all of those things if that interests you.
And if you ask me about this, just please don't be disappointed. So please just watch this video, because I just can't bear another disappointed client. Please watch it. It's really a wash either way. It's going to be good either way. Either way you go is honestly going to be good. Don't sweat it.
Yeah, I love it.